when you're not doing quant, because of the size, because you have to do it manually, okay, and maybe some computer intervention, you're not able to track a lot of companies. So generally people limit themselves to the BSE top 200.
Because preserving capital, as you always say, is more than making
I
generating
think
an
it's
alpha.
much more important than growth of capital. Preservation of capital is number one.
When I see the portfolio of INVasset, gold, silver, copper was never part of it, or even the ETFs were never part of your portfolio. Is this some kind of a strategy, or it is just a miss from your quant model? When we talk about your quant model, we want to understand how much is the human intervention, if at all there is, or all your decisions are being taken by the quant and your algo-based systems that you're making. You've taken cash calls 3 times in your tenure as a PMS before. So what is it that you are able to see, or your quant is able to see, which everyone else was not able to see? Because at that time, I remember the cash call was the much talked about thing that you took as a fund manager. Hello, everyone, and welcome to Returns and Beyond from Wealth One. My name is Naren, and I'm your anchor for the show. This is a show on the PMS and AIF and how the investments happen and what the fund managers think behind the curtain. So today is very interesting because we have Mr. Anirudh Garg with us. Anirudh is the research head, the founder, and the fund manager of INVasset PMS. So welcome, Anirudh, to the show.
Thank you, Naren, for having me. It's a pleasure.
So this has been a marvelous journey that you've had in INVasset PMS. We've seen that in the last 5 years, you have given a CAGR of upwards of 30%. And few of the years, it has been 128% massive returns. So how has been this journey so far?
I think, Naren, it will be very unfair to talk about the last 5 years only. Though at INVasset, I understand where you're coming from, that we have had only 5 years of history. We started 8th of January 2020. But these 5 years for any asset class all over the world, be it equity, be it real estate, be it gold, everybody is now gushing about silver, copper, everything has gone up really because of the supply of money. And we at INVasset have also been, in that flow, we have also made good money. But yes, my target Narender and INVasset has been very simple. When I just started my fund management, or maybe my investor journey back in 2007 or early 2008, I was going through a class where, my teacher told me that the only reason why people do not make a lot of money in the stock markets is because they do not want, or do not know what they want from the stock market. Yeah. So I was made very clear to a concept that whatever, like the stock market is also just an asset class. And what do you want from this asset class? What do you want from this business? You should know that. So we at INVasset defined it very properly. Though there are no guarantees of return in stock market, but we as fund managers at INVasset, we hope for that. Nifty, I believe, will always be a 12 to 14% compounder. Of course, the last 5 years, Nifty has also done around 17%. But if you look at the 10 years, 20 years, Nifty is a 12 to 14% compounder. That is where you will find Nifty. So we want to do 1.5 to 2x of that. If Nifty band is 12 to 14, we want to do 18 to 28. Last 5 years, Nifty has done 17. Okay, so we wanted to do 35, 25 to 34. We have done that. So we are in like 32 or 31, something like that. So I think one inference one can draw for your investors here from this point is that any investor investing in any asset class should know what return he or she wants from that asset class, rather than just blindly following, the trends of both greed and fear.
This is damn interesting that you should know your asset class. So we see that now the young generation is getting into the equities as an asset class. We see that every person at the 18 years gets a demat account opened on the first day. And that's how the new generation is responding to this particular asset class. And when we talk about INVasset PMS, we see that you are a quant-based PMS. You first shortlist 1,500 or track 1,500 odd companies on a real-time basis on 170 parameters. So we want to know as to when these investors, the retail investors who are coming into, who are just jumping into the fray, what is it how should they be shortlisting the companies which comes into their universe, and how do you do it? How do you shortlist your company? How do you make what are your 170 parameters? Of course, we can't discuss all 170. What are the major parameters that you track to shortlist a company?
Okay, so then let me reiterate on a fact that I tell to many people. A lot of us have, the older generation generally has this thing that the newer generation is not that smart, but science proves it otherwise. As as the generation is coming, it is smarter from the old. So I believe that the newer generation, the Gen Z, which you call, or something else has come after that as well. Somebody was telling me, they are very, very smart. They're very, very tech savvy. And technology is something which in any field, especially the stock markets, will help create newer forms of investment, newer models, and things will only get better from here, because as the markets are getting bigger, we need more smarter people coming into the markets. Then when it comes to investment, see, for any person if we call them retail, let me reiterate on the fact again that I tell everyone that the best way to invest in the equity markets is through mutual funds. Mutual funds, SEBI has worked relentlessly, and in the last 20 years is now paying off, where you have the very fine fund managers working for you at very fractional or nominal cost. Yeah. This is possible only in India, and I think we should all owe it to SEBI for doing it. Yeah, a very clear direction. Now we are owning a part of things which the big corporations were taking away from us. Yeah, my old mom and shop near my house, where I used to buy since I was a kid, is now being taken up by Blinkit, and I'm very sure in the next few years maybe it will not even exist there. So how do you get it back? It is through the stock market, and the best way to approach the stock market is mutual funds. When it comes to our 1500 companies or 170 parameters, see, everybody has their own strategy. What happens is that when you're not doing quant, you are, because of the size, because you have to do it manually, okay, and maybe some computer intervention, you're not able to track a lot of companies. So generally, people limit themselves to the BSE top 200. Yeah. So when you are in the BSE top 200, again, if the Nifty is at 12 to 14% compounder, the strategies that we have worked on BSE top 200 gets us somewhere between the, from 12 to 14, it gets us in the 16 to 18, or say 18 to 20 max. Yeah, that is where the real competition is. Everybody is, competing in the same group, and that's why the returns get a little less. Yeah, and these stocks are generally listed in the futures and option segments also, which gives them a lot of liquidity. But again, the crowded trade takes place. Yeah. So what we decided at INVasset was very, very simple, that let's not focus our wealth creation from the top 200 companies where everybody else is doing. Let's move out of it. Yeah.
Okay.
So initially we moved, when you're talking about very, very initially, we used to track all 1500 companies. But then as the size started getting bigger, we were like, okay, let's not do the companies which are less than, say, 10,000 crores. Yeah, until unless something you find between 5 to 10,000 crores, which is extremely, extremely attractive, though very, very difficult to find such companies. Yeah. So then I would say today, if on today's date, we are doing somewhere between 700 companies, and in that 700, the top 200 are included. So when we have to consider at what stage of the market do we consider the top 200 companies is different. So we don't generally always buy from the top 200. We move out of it depending upon the market conditions also. And the parameters, okay. So the parameters are strategy based. We have 4 stages: value, growth, quality, and safety. Each stage will have, parameters according to it, according to the importance of what we are looking for in the stage. For example, the value stage, as the name suggests, we are looking for value. So we look at all those discounted cash flow models, historical valuations, and comparative valuations, sectoral valuations. Value will be given more preference. Yeah. So firstly, deciding what stage you have to be in.
So that means market cap is not the only parameter to select your universe. You will be having a different set of 700 companies at different point in time.
No, the set of 700 companies remain the same. Out of 700, which ones to consider changes from stage to
So
stage?
can we say that market cap is one of the parameters, major parameters to get the universe of 700?
Not only market cap, it will be very, very unfair to say.
Okay.
It is liquidity, market cap, and market cap is a major one. Yeah. But then what is your my main preference when selecting a stock, when to consider is liquidity. How liquid the stock is. If the stock is not liquid, then there is a problem. Yeah. My
Fair.
stress test has always been that I should be able to do it in 3 days. If I have to sell the entire portfolio, I should be able to liquidate in 3 days. Though, of course, let's say 95%, 5% can move, any stock can move into those segments which where you get the bans and everything. But overall, I believe that I should be able to sell. We have done it in the past. 95% of the portfolio should be disposed within 3 days. That is what we focus on. Though, again, no guarantees that we'll be able to do it in the future. But our major onus is on this, and that is how we select the very starting point, our sample set. Yeah. And then growth stage, we are looking for growth. As I told you, we look for relative change. Then this is where, say, out of 170 parameters, around 80, 90 work on this depending upon various sectors. Yeah, each sector will have different parameters working. What will work for a new age company like Zomato would not work for a banking company like HDFC Bank. So the indicators, the matrix is totally different for each sector. Though they have common things as well, like return on capital employed is something that you cannot, compromise on. Yeah, and quality of management is something that you cannot compromise on. So these are the things that remain the same, and rest the parameters changes from what you're looking in a particular time or a particular sector or a particular stage in the market. Third, when we are in the quality stage where we feel that the markets are expensive, that time we are looking for all those Warren Buffett type companies. So all the factors that you will read in the Warren Buffett books, yeah, return on equity, return on capital employed, high quality of management, maybe some moats working for them, maybe competitive advantage, maybe the leaders, maybe incremental leaders. That is what we look for in the quality stage. And finally, in the stage 4, which we are famous for, the safety stage, a lot of people talk about that we move from to cash a lot of times. Yeah. That is where we look for how expensive the markets are relatively and what is the exuberance level in the market. We have a lot of models which spot exuberance for us. We have been able to do it in 2024 December when nobody was talking about the exuberance in the market. And we did a small mini, which I didn't want to do, but yeah, just to set the context right, we did it a couple of months ago as well. And yeah, when we spot exuberance or irrationality in the markets, we have factors for that as well. So it's a combination. The main thing I would say when you have to look for factors, if we have to give it something back to the listeners, is that what you're looking for, define that, and then branch out the factors out of it. You'll automatically get your all those factors and all those things you're looking for slowly and steadily as you gain experience.
Brilliant. And of course, the safety stage is something that INVasset is known for. And we're going to go to that safety stage and dig.
We are known for a growth stage as well. Yeah, but yes, it's a combination. Yes.
Yes. Because preserving capital, as you always say, is more than generating.
I think
an
it's
alpha.
much more important than growth of capital. Preservation of capital is number one.
Okay, so when we talk about your quant model, and we want to understand how much is the human intervention, if at all there is, or all your decisions are being taken by the quant and your algo-based systems that you're making.
Okay.
And also, just one part of it, if there is a human intervention, do you overrule the quant, what quant indication is giving to you?
So for my personal portfolio, yes, I have overruled it. And let me come here and tell that every year, my personal portfolio underperforms my clients' portfolios. Yeah. So what I've seen is that whenever I have interfered as a human, that recency bias has always set in and I've always performed less. Yeah. In terms of clients, yes, it's totally quant based, though the quant model is improved over time. But whatever improvements we make in one run, by one run, I mean that, so to give a context, the first run in the markets post-COVID came from March 2020 till September of 2021. Then from June of 2022 to say September of 2024, and then from February or March of 2025, now the third run is going on. Yeah. So whatever changes that we do, whatever improvements that we do in one particular run, we implement it in the next run. So we are always preparing as humans with the quant for the next run to improve the quant. For my clients, it's totally, I would say, uh, let me go ahead and say it is totally quant. Yeah. Sometimes where I feel that something totally different has happened, which the quant has not seen before, just to rudder the ship that time, we get the human intervention. And for example, now, back in September of 2025, when we took a cash call and told our clients that we are just taking it for a couple of months, there was something abnormal which the Indian markets had not seen according to our quant models. So we were just taking a break so that it's okay to sit back and sit at on the side for some time, and then we'll take a decision as and when. Now, right now, when we are doing the podcast, we are redeploying into the market, whatever. We just so the human intervention comes very less, but only to an extent where something is happening in the quant which was not expected, and something which needs more clarity for some time. So that time we just use the human intervention to take a break.
So talking about this, taking this break from the market, or talking about the safety stage that INVasset is popular for, you've taken cash calls 3 times in your tenure as a PMS before. The first call came on June 2021. That was pre-Ukraine war. And that's how you predicted that there's going to be a fall, and that's when you exited the market. So what is it that you are able to see, or your quant is able to see, which everyone else was not able to see? Because at that time, I remember the cash call was the much talked about thing that you took as a fund manager.
See, so there are two things. I've been an investor in Narendra throughout my life. So what I used to notice as an investor, that fund managers never take cash calls. Why? Being a fund manager, now I realize it, but I'm made like that. And I wanted to provide something for the clients. That's why I'll keep on taking cash calls in the future as well. When you're taking a cash call, firstly, you're not making anything out of the AUM. For example, we, a performance-based fund, we do not charge either management fees or neither the performance fees, nothing from the entire FD or arbitrage fund or the liquid fund money that comes in the client's out. They're totally go to the client. We do not charge anything out of it. So first thing is you're not making anything out of it.
And that's why the fund managers refrain from taking
the cash calls. Yes. Secondly, especially in the mutual funds, you're not allowed to go below 70% of the invested value. So the mutual funds also don't do it. Is it generally beneficial in a bull run? I think maybe not. Yeah, in the long run, it is not beneficial. But my only importance, why I take it, is that somewhere in my life, I will see something like a 2020 or a 2008 or a 2000. So these bear markets, this young generation, these new investors, this majority of the public which is shifting from the FD culture to the equity culture, has not seen it. I've seen stocks go, not stocks, portfolios, losing around 60 to 80% of their values. What happens then? Your 3-year to 5-year money is depleted. So you have to be cautious for it. And it's okay, when we take cash calls when the markets are expensive and exuberant. When the markets are expensive, मतलब बाजार भारी है भाई, and exuberant है, मतलब लोग पागल हुए हैं. That is expectation, yeah. If we have to summarize in the very layman's language, उस टाइम पे पैसे बन नहीं सकते हैं, पैसे जाने के चांस ज़्यादा रहते हैं. So we are very particular when we find that the markets are expensive and exuberant. And to answer your question, this is what we try to spot. The first thing is the intention. The second thing is what we spot is the expensiveness of the markets and the exuberancy in the markets. And then we take a cash call. Yes, we took it 3 times, wanted to take it 2 times. The third time was something where we didn't want to do it, but we were seeing signs which the Indian markets in a bull run I had not seen. So I just did it to protect the capital and take a temporary pause for some time. How do you know that you are entering a bear market? Yeah. So one of our indicators has a peak and trough. I cannot talk about that indicator here because people tend to interpret it differently, So it has a peak and a trough. So generally, that peak is taken off. You can see it in my letters I've written to my clients. I've explained it. So what happens is generally in a bull market, the peak of that indicator is taken off in say 3 months to 6 months post a bottom is made. For example, we made a bottom in February or March. The peak should have been taken off till say September. Yeah, the peak was not taken off. That was a problem for us. And then, if it is a bear market, if the peak of something is not taken off, you wait that the trough is taken off. The trough was also not taken off, which means that the Indian markets temporarily entered into a fractured or a fragmented stage. So that's why we took a cash call this time, because just to double check that are we entering into a bear market or not. Yeah, now we have entered again because the trough was also not taken off. We are sure that, or not sure, we take a collective, calculated call that we are not entering bear markets and things should be good from here.
So I want to understand about this latest cash call that you've taken. 3rd September 2025, you were on an interview in one of the news channels, and you said that we are in a structural bull phase, and you see Nifty hitting its all-time high, and you see Nifty crossing 26,300 very soon. Okay. Suddenly, 29th September, we see that you've taken a cash call that means withdrawing each and every percentage of your money from the markets. So what happened in these 25 odd days that made you change your heart?
So nothing much happened, but it entered a phase where we were tracking markets so closely that, as I was telling you, the peak and trough or indicator, we were very, very near to the peak. We were very sure in the next 1 month or 1.5 months or 2 months. That time I told that maybe in the next 2 to 3 months, we will, if you're talking about the CNBC interview, I think, yeah, then the next 2 to 3 months, we should see an all-time high. Okay. Rather than going that way, the entire small cap, mid cap portfolios, markets are generally divided by, generally explained by their wider indices, not just the Nifty. Yeah, they started taking a back step. The small caps almost, fizzled out from there. They were going so strong and they just fizzled out from there. Why? Firstly, the valuations were a concern for all of us. Still, I would say that the small caps in India are very, very expensive. Yeah, especially the small cap, not the mid and large, but small caps. They started taking off lows which they should not have. But till today, we are 6 months or 4 months from there, they've not taken off their lows which they made in February, which assure us that we are not in a bear market, but the strength of the bull market is also not that strong. So just to analyze what type of portfolio do I want here? Do I want the growth portfolio or not? Should I have 100% of my equity into the growth portfolio, or should I have something of a quality portfolio as well? This run was totally a growth run, all starting from Adani's to, PSUs to everything. This has been a growth run. In the last 1 year, growth has become so expensive in India that the smart money shifted, I would say, let's not say overnight, but over a month, shifted from growth to quality. That is from small caps or small mid to
large
mid
caps.
Or mid large. Yeah, or large even. So just to take that into consideration and align the portfolio accordingly, we said that, okay, let's take a cash call and we will enter in a few days when we feel that a correction in the market has come and it's a stabler base for the markets to re-enter. I think whatever we sold at, when we were buying, it was 4 or 5% down that selling value as well. So this cash call has also actually worked, but this was not a cash call that I really wanted to take in the start of the run. Yeah, a huge change which happened in Indian markets due to the valuation gap that had been between the mid caps and the mid caps, small caps, and the large caps led us to do so. Is this cash call a part of the safety stage? No. The markets overall are not expensive and exuberant. Only the small and mid caps had a problem, and that is why we took a cash call to readjust our things And then we had this in provision from day one that if something like this happens, we'll take a breather because, the fall in a bear market, which we were trying to avoid if the bear market comes, is very, very steep and you're not given even, enough time to react to it. So going on cash, I would say, is something not that bad as it is perceived to be. Cash, I believe, at times where you have to focus on the preservation of capital is a good asset class to be in.
Absolutely. So, what is the indication that you are giving now, 2026, is you're redeploying, number one. That means you are seeing some kind of a growth that is happening in the market. Second, at the same time, you're saying that we're not in a complete bull run. So what do you see in 26, or what is it that you predict that this is what is going to be in store for us?
See, I believe there will not be that free money as it has been for the last 5 years.
Yeah.
Things are not that simple this time. And it would take your experience and knowledge and your hard work to make money into the markets. You may see a bull market in commodities because the inflation concerns are over, firstly. And secondly, there is a structural reset happening all over the world in terms of how things are between the biggest buyer of the world and the biggest seller of the world. Yeah, of course, US and China. And this reset will give precious metals a lot of, I would say, center stage, which was not given to them for a very long period of time. Secondly, the Indian companies have taken the Group B. If Group A is USA and especially India has taken, if USA is in Group A and the NATO nations are in Group A, I believe India has entered Group B now, and not politically, I don't know how, but yes. And then the money not flowing to India, and FII is totally taking out money from time to time. This phenomena should also be there. So we are looking at something where something is very, very bullish, something is not that bullish, and something is very, very bearish for India. So you have to consistently track all these factors and at the same time preserve your capital as well. This is how INVasset would be thinking going ahead.
So which sectors? So you say that now you're redeploying. आपको कौन से sectors में ऐसा headwinds दिख रहा है कि yes, these are the sectors that are going to lead the market or lead the bull run or a semi bull run, however it is. क्या दिख रहा है?
Naren, I'll give that statement to you maybe in a webinar I'll do with you. But right now, since we are deploying, it will be unfair for my investors if I talk about the sectors also in this podcast. Yeah.
Okay.
But yes, all of us can see the relative changes that are happening in the Indian society. Just look a little deep. Something like 28,000 crores coming into the stock market, GST being reduced. Yeah, taxation is good. Inflation has come down. I think we are all intelligent enough to know which sectors do have the tailwinds from here.
So how I see it is the finance sector, the metals. Of course, you said that precious metals is booming.
Yeah.
Finance, metals, all the financial intermediaries is the ones that we see because of too much of money coming in to the flow with the DIIs taking over. So these are the sectors that I feel personally are going to perform, and just wanted to have your view on that.
I think all these sectors that you're talking about are something on INVasset's watch list as well. Yeah, I think.
Okay. Yeah. Talking about precious metals, gold, silver, copper. Since the inception of INVasset last 5 years, if we track the trajectory of these, they have all been 3x now. But when I see the portfolio of INVasset, gold, silver, copper were never part of it, or even the ETFs were never part of your portfolio. You have used them as hedge only. Is this some kind of a strategy, or it is just a miss from your quant model?
So how we used in the past, or how our strategy has used precious metals in the past, not precious metals, I would say, only gold among precious metals. Because silver has been a center of attraction. Now it was never a center of attraction earlier. It's just because of this major big reset that is happening in the world that silver has gained
So
attraction.
that relative change that you talk about
Yeah.
has happened in silver, but then the quant of INVasset was not able to judge it, or was it a strategy to keep it away?
No, our thing is very, very simple. We do not, let me go out and say, we do not specialize in precious metals. Okay. We are a long only equity fund. That is what we've aspired to be, and that is what we will always be. So what was precious metals to us? Precious metals was for us that we will enter precious metals when we believe that the market is going into a bear market. Okay. That time
As
we'll
hedge.
take a hedge with gold. Okay. My funda is very, very simple. When I'm buying growth in the markets, I want an underlying. By underlying, I mean something that is working for the company, not just demand and supply. Gold and silver do not accept demand and supply, do not have anything working for them. Okay. And this time, what has happened, and all of us are talking about gold and silver, is that something really good happened in terms of, as I told you, the USA China upset. I don't think demand and supply of silver is a problem. It is, but not that much that supply will not be able to meet demand of where the actual demand is, like in batteries and stuff, and whatever Samsung made a battery, whatever is happening. We will be able, the world will be able, has enough silver to cater to that. But the problem is now that central bank buying, which has happened and happening in all precious metal. If you follow, you must have noted that China has made sure that nobody will supply silver without asking the government. The total ban on exports of silver.
Yes.
And then RBI, firstly, you could not take loans on silver in India. Yeah, only gold was allowed. Now you can deposit your silver for loan collateral as well. So it was an industrial metal. We would say semi-industrial metal. Now it has become moved more towards precious metals part because the central banks allowing it. Somebody had to do it. China did it. The rest of the world followed. Yeah. So this relative change, we were, I would say to a fact that we spotted it very, very well, only based on price movement, nothing else, breakouts and everything. But we did not buy for clients because we just told them we are a long only equity fund and we will not use commodities. That defeats the entire purpose of what we are and how we do it. Looking at the hindsight, should I have done it? I believe yes and no. Yes, why? I could have had a special meeting with clients or written to my clients that I wanted to do it. But that would have come at a cost of me reacting to a change immediately and not preparing for it in the past run, which generally leads to mistakes. So I and my team were very, very right in spotting silver and gold, but we did not buy it because it was not a part of the curriculum, if you can say. If it was not a part of the curriculum, I cannot just introduce it in between and then, then I would have bought Bitcoin also, right? Then I will buy Ethereum also. Then I will buy all these stupid coins as well. Yeah. So you need to know what chapter what language, what course you need to study on, and do not introduce things in between. Though going forward, should precious metals be a part? I believe yes, but overall only as a hedge, not as an investment, because they lack the underlying. Underlying should always be there. So there comes time where sometimes a Bitcoin is up 10x or silver is up this, but overall, yes, the run is real, and generally you're able to harness these trends through Indian companies as well. There are a lot of Indian companies, we will not name them, so please do not ask us. Yeah. Which can be very, very good proxy plays for all these metals and everything.
सो इंडिया के एजुकेशनल सिस्टम को देखें तो वहाँ पे कैरिकुलम चेंज हुआ है. एनसीईआरटी बुक्स दोबारा से लिखी जा रही हैं मोदी जी के आने के बाद खासकर.
Absolutely.
तो क्या इन्वेसेट अपने कैरिकुलम को चेंज करके मेटल्स को बीच में नहीं लेकर आएगा?
नहीं लेके आएगा because they do not have the underlying working for them. Yeah. Then if if I have to let go the underlying point, then I'll have to include everything from a Bitcoin to an Ethereum to everything. I'm not ready for it.
And of course, the Bitcoins are not part of your curriculum at all.
Not at all.
Okay.
See,
any specific reason why you're not on you're not tracking as an investor, not as a PMS, but as an investor, crypto.
I have been mentioning that point again and again, and that point is the underlying. If for Wealth One, Naren is working. There is nothing working for silver, gold, or there's nobody working for them. I want the human factor, the human excellence, the human hard work, the human sweat, the human blood working for somebody so that each and every year the product is improved. There is nothing, it's just pure demand and supply. So I am not ready to just play demand and supply for my investors. I can only use it as a traditional hedge, rest nothing else.
All right, brilliant. That is so much of insightful information coming from a seasoned investor and a seasoned fund manager. Thank you so much, Anirudh, for this. Okay, just moving on to the understanding of gold, silver, copper has been the talk of the town throughout the world. Okay, uh, it has gone 3x, and people are now talking. There's so much of noise in the market saying कि अभी ये यहाँ से crash हो जाएगा, अरे नहीं ये तो अभी यहाँ से 2x चले जाएगा. So what is your take on it as an investor, so that हम अपने viewers को inform कर सके कि what is the real thing that is going on behind the curtains?
See, I believe that all these international metals, as we call them, right? Gold, silver, copper, aluminium, palladium, all these are controlled by forces which are far, far greater than what we all are equipped to understand. Yeah. So the best way to handle these is through technical analysis. Yeah. So the fundamental right now looks in the favor of the prices. Okay. Disclaimer here that in my personal portfolio, I may have positions in gold, silver, copper as a traditional investor, but I do not have them in my PMS, nor I'm planning to buy anything of that sort in my PMS going forward from here for the next few months as well. But somewhere, I think you should stick to your game. You should stick to your companies, your entrepreneurs, your management, your product, and not be weighed by these things. Yeah. Or I think your models as well. If your model is such where they can come automatically and go automatically, then it's also okay. Yeah. So rather than just focusing on what silver will do, what gold will do, I'm not a Pandit Naren. It's very, very difficult to understand what they're doing, or maybe I do not have the required knowledge for it if I take it that way. But somewhere I believe that sticking to your own game, your mantra, which has been proven over and over, which has seen everything from a post Harshad Mehta crisis to a 2000 financial, tech meltdown, then 2008 financial meltdown, then 2020 COVID meltdown. When we've seen everything and we've survived in that, the model has survived, then what is happening overnight? It is just something that you have to avoid over time. If I didn't buy Bitcoin, did that affect my CAGR? No. If I didn't buy gold, silver, did it affect my CAGR in the short term? Yes. In the long term, no. Yeah. So it's very, very simple that if your model is able to, I believe so, if your model is able to, if your model and your mind even is able to get it into the stream of things and they can automatically come and go, then it's all right. Otherwise, it's not for me.
All right, brilliant. That's great. So, taking you to the international scenario now, India-US relations, the India-US trade deal, which is again the most awaited document that everyone in the equity market is waiting for. This gentleman Trump, who is kind of holding it on for some reasons. So, I want to know about your mind. So when Trump came to the office, okay, you were a big fan of Trump, and you said that he is got that business acumen, he's got that bargaining power, and he's doing everything right. When he started off with China also, you kind of gave a thumbs up to this. What do you think about him and his strategies now?
See, Trump is doing wonderful if you talk from America's point of view. Oh my God, what a prime minister or president they've got. He's doing everything and anything that he needs to do to get America back on its foot. America as an economy right now is broken. To restart it, reshoot it for the future, for the next 30, 40 years, you need these steps. So I believe all the steps that Trump is taking for the US are absolutely right. Of course, we were not prepared for it. We were expected that it will be majorly a war between China and a financial war between China and the US, and India would not lose anything out of it. But yes, his rejig is very, very different. And I believe for him, he's doing the right thing. For us, it's what we as India did not work hard enough because, let me go out and say, because of the government policies of the past. We were not prepared for it. Unlike China, we are not able to stand up to Trump right now. Though our government is doing it, but doing it with substance and doing it without substance makes the entire difference when you come on the bargaining table. If you do not have that substance, then the bargaining favors the one who's more stronger. Right now, US is more stronger than us. If they stop from us, they tend to lose less than what we tend to lose if they stop from us. China, US, China is more stronger. Yeah. So I believe that all these things, the trade deals and everything, they will happen in the future. Yes, it's a temporary setback for India. And rather than, just blaming Trump and crying foul, this is a wake up call for us that, okay, it is time now that we reach that level that, we can also ask people that we want to do it in a particular way based on our strength and not zid. Yeah, this is zid, I suppose. If though it is very, very difficult to say, you can just sit on the side stands and say anything, and then the prime minister has to take that hard calls. And looking at his history and his development model, and all of us, I believe that he is all right. He is one of those better prime ministers that we have had in India, and the calls taken by him have generally worked. I think this was a time. This was the time where we should have wooed US in a little different way, because we tend to lose a lot if the trade deal doesn't happen according to our conditions. But every government has a huge machinery working for it, full of extraordinary smart officials. All IAS officers and all. So I'm very confident that Indian government will be able to do it in the future. And apart from that, if it doesn't go through the way we expect it to, we ourselves are a very, very strong nation. And it's a theory, and it automatically happens that where the population is. See, I always say that you require 3 4 things for a stock market to flourish and a country to flourish. First is you require a democracy. Oh, India is one of the best democracies of the world, we know that. Then you require a demography. Of course, demography, we can see demography everywhere.
Everywhere.
Yeah.
The
Then you
kind
need
of people we have.
yes, then technology. Yeah. So technology also we are making inroads, so we lack much, much, much way behind China. But yes, we are making the and the fourth is a taxation structure. The taxation structure is something that is happening at a very good pace in India now. The Indian government is very, very conscious about it. So the recipe for India is right for the next 20 years. These are small hiccups. You will make mistakes, you will not make mistakes, then amend those mistakes, and then work for the long betterment of India. I'm very, very sure 20 years in down the line, Indian Nifty will keep on growing at 12 to 14% as it has grown in the last 20 years.
Excellent, excellent. So just to understand this, you always say that the market factors in whatever is about to come.
Yeah.
Like they factored in the COVID. The day we had the lockdown, it was the rock bottom of the markets. So this India-US trade deal, which is hanging on the kind of getting delayed for some reasons, has the market factored in the US deal, or the surprises are still in store for us?
Looking at the indicators that are there in the market, no, I don't think they're factored it till now, because that is why we see 20 March 2025 till today. Indices like Japan, US, US Dow, US Nasdaq, Taiwan, they're all up 35 to 40, 50, 60%. Yeah. We are where we have done just 10, 12, 13%, and maybe portfolios not doing that much as well. So Indian markets are trying to, factor in. Firstly, we were expensive. Then came the problems, and Now, I think that is something that has held back Indian markets, but I also believe not much from here. You know, if the trade deal goes through, that I believe should go through in the next 2 to 3 months, things will get better for India, because everything else on the Indian front is all right. It is just that we are expensive in the small cap category. The old economy is a little expensive. But on the other hand, we have our GST cut in place, which is a phenomenal, I would say, uh, change that has happened for India. We are become digitalized in the last 5 years so much that we never expected post Geo coming in, and then the income tax cuts that were brought by the Prime Minister, putting around 1.5 lakh crores in the hands of the Indian consumer. Yeah. So the equity culture that has started in India, the SIPs that are coming in, I think a lot of relative changes are lying in India just to be recognized, and companies are doing well. If you look at sectors, it's just that the broader indices, small caps are not doing well. Rest everything in India is all right. Yeah. Nifty is close to its all-time high at 26,300. Yeah, though we've not decisively taken it off, but I'm very sure that we should be taking them off in the next 1 month or so. Yeah, that much confident we are. I think we have a formidable bottom now that have been made in the small caps part as well, because they have taken a time and a price correction both. And I think things from here should be all right for India. I'm not
So
looking at
positive
anything.
for investors. The calendar year 26, 27 is going to look like.
I am 100% confident that 100%, not even 99, 100% confident that this will be one of those good years that all of us look forward to.
This is such a
The
relief.
calendar year ending December 2026.
This is such a relief coming from an authority
And we
like you.
should take, I'm not an authority, I'm just a follower, a bhakt of the market, but we should see 30K plus levels on the Nifty and before December of 2026 if something globally doesn't go totally haywire.
Wow, this is huge. 26 December is going to touch 30,000.
Before that,
Before that.
yeah.
So this is going to be a big upswing. So what is it for INVasset PMS? What is the kind of CAGR that you're looking at for this, or the returns that you're looking at for this calendar year, January to December?
Again, I do not answer this question, but yes, over a 3 year period, in our history, we have done 1.5 to 2x of Nifty. We will be, I am very confident, though I do not guarantee anything, nor any SEBI-registered fund manager would do. I believe we should be in that 1.5 to 2x category.
Brilliant.
Since the CAGR for the last 1.5 year has not been that much, 1 year maybe, 1.5 year maybe. So I think we'll be able to make up for that and make up very strongly.
Superb, superb. So just digging into your personal setup now a little bit. So you've mentioned before that Mr. Parag Parekh, Mr. Madhu Kela, Mr. Rajneesh Garg, your father, all three have been your mentor, and they have been instrumental in grooming you as an investor, as a fund manager. But I also see that all of these three people, they come from a different investing style. Parag Parekh sir is from the value investing. Okay, Madhu Kela is from the macro level investing, and Rajni sir is entrepreneurial investing. So, how do we define Anirudh as what is his investing style?
Okay, so everybody leaves an impression on your psyche, as they enter your life. And for me, let's not take names of the things that, okay, let's talk about Parag sir. Parag sir taught me the value of ethics. He was the most ethical man I knew out there. Yeah, very ethical. Even all of them, all the three gentlemen, Parag sir's focus was too much on it. He taught me the value of money. How a new car versus a second-hand car will, help you preserve your capital, what to look for, how not to be a spendthrift, how to look for value everywhere, how to cater for due diligence. Rajneesh sir taught me the value of people, that how you should never break anyone's trust. Yeah, and never be afraid to take very big decisions. If you get bullish on a particular sector or commodity and you have the right reasons for it, and then you buy 5-10% of your portfolio, तो फिर क्या मिला? Yeah, if you are able to take a portfolio and convince everyone that okay, my calculations tell me that I am I may lose 10-20% on this, but I tend to make 120% on it in the next few years, then I have to take that call. Yeah. If you get something big, how to make that even bigger is what Rajneesh ji taught me. Madhu sir was very, very clear that let's talk about facts and figures only. Yeah. And anything which is not supported by facts and figures is not to be considered. So anybody, not even these three gentlemen, a lot of gentlemen, a lot of books that I've read have had let impressions on me, and then the strategies that I've made them with them over the course, and then made it totally quant based with no human intervention, is I think what will lead to the success of INVasset in the next 2 decades.
So we can safely say that Anirudh is a mix of Mr. Parag, Mr. Madhu, and Mr. Rajneesh. He's imbibing all the good parts from him. Is that correct?
Yes, and not even these three, more than I think all of us are in a
Taking
way.
a little bit from
Yes,
here and there.
but
And
two gentlemen that have led very, very big impression. One is, of course, my father. I would think 80% of the contribution to is his. And then the rest 20%, if I own it to the top two, would be Parag Parekh sir.
okay. So the investor, the new investor, or maybe the seasoned investor, what is the advice that you have for them if they have a certain amount of capital with them? There is so much of noise in the market. There is so many formulas going on in the YouTubes and the Instagrams, option tradings, going for direct investments, going for futures. What is it that an investor who does not have the technical expertise as yours should do?
As I told you, firstly, mutual funds are the best thing out there. Go buy mutual funds. As simple as that. If you're not seasoned, don't go for PMS AIF also. Go for a mutual fund. If you spent a few years in the mutual fund industry, then go for the PMS. Then after spending a few years in a PMS, go for an AIF if you have that capital. And when it comes to own stock selection, I think it's much more hyped. It's much, much more hyped than it is worth. I'm telling you that. If I do not have the passion for equities, I know a gentleman in India to whom I'll be very, very happy giving all my capital to manage at pennies than the amount. Like if I give my capital as an Anirudh, if I'm not managing INVasset, if I give my capital to the gentleman that I've selected over a period of time to manage my capital, I think I'll be making less expenses than what I'm making, keeping the staff and keeping the teams to generate the same or maybe a little better or maybe less, a little less, something in that zone return. So it is the passion that we are working for. If we just want the return, oh, there are wonderful, wonderful fund managers out there. And let me say this, focus on what you specialize in, what is your interest, and just, sattas in, as we call satta in stock market is very, very easy. You just need a laptop and an internet connection and you are set. Yeah. That is something which is options, futures, all these things, margin funding. These are all tools of mass destruction. You will end up losing everything that you've put in. Yes, if it is your passion and you're thinking about it 22 hours a day, even while you're sleeping, if you're thinking about it, then of course I'm very, very confident that all of these brilliant, brilliant generations that are coming will make up their own formulas. And of course, in this market, the tuition fees is very, very expensive. You all have to pay that. You will make losses. You learn from them. Better you learn from other people's experiences, and rather than making your, because experiences here are very, very costly. And as I told you, mutual funds, PMSs, AIFs, and then maybe if you're very, very passionate, then do your self-investing. Otherwise, never, never do self-investing. It's much more hyped. You should just be concerned about wealth rather than how the wealth came from.
So this is a big insight because I personally know so many investors who say that, okay, let's first do direct equity and then we will go to mutual funds.
Oh, it should
be the other way
last
around.
part.
It should be the most
Last part, for
thing,
sure.
yeah, most technical part.
Last part.
And most of us should avoid it and give it to
It
the
is
next
like, going to the gym and not taking services of a personal trainer. Yeah. Go elsewhere, you'll know how expensive these things are in the rest of the world. Maybe then you'll love what is being provided to you here in India. India is one of the cheapest markets in terms of what the mutual funds are charging you. I think they're charging you nothing and giving you such phenomenal returns. And secondly, sometimes we are swayed by the fact that how much returns do we want? One particular year of 128% at INVasset does not mean that there will be a 128% coming every year. Yeah, I'm very, very sure that 100% will not be coming every year, and maybe not coming in the next 2-3 years as well, because you're sitting on a higher base. So you just have to be very, very sure about what returns you want and select your MF accordingly. And with MFs, the good thing is that you have NAVs, maybe on Wealth One website as well. For every PMS I was looking, you've made a wonderful website, Naren.
Thank you. Thank
Yeah.
you so much.
And if you have the NAVs, you can just test how they did in bad times, and ask the fund manager what he has learned from it, and then take decisions accordingly. I think a fund manager is also a strategy only, right? Rather than making your own strategy, if you're able to spot a right fund manager, you have decoded the strategy.
So when we talk about the investments and how much money do you want from your investments, so what should be the right ask from the markets?
I think
Because
it depends.
sometimes we say that, okay, I'm going to double my money in a year or so, and this is what my ask is. And I see young investors going to option trading and saying that I'm going to double it in few weeks. So what should be the right thing that we are asking for from the markets?
See, in this market, it's very simple. You cannot make quick money. You can easily lose money very quickly. Okay. So generally, I am telling you, let's look at the benchmark. What does a benchmark mean in English? Something that you can, mark your things against. Yeah. So the benchmark is a 12 to 14% product. Okay. So everything has to be around it. So at INVasset, we believe that in India, cycles are generally 3-year cycles. Okay. 2001 to 2004, 2004 to 2006, 2006 to 8, 9 to 11, 11 to 15, 15 to 18, 16 to 18, then 2021 to 2020 to 2021, then 2022 to 2024, and now it's happening. So generally a 2 to 3 year cycle. We believe that if a person stays with us for 3 years, what should he expect? Or rather, what are we expecting? Not he should expect, what are we expecting? कि हमारे साल तो 3 साल रहे, 3 से 4 साल रहे, that person should be able to double his money, which means simply a CAGR of 18 to 24%, which I believe is phenomenal. Again, the Nifty does 12 to 14. If we defined it via Nifty because I'm a fan of Nifty, 1.5 to 2x, 18, 28. If I'm in that zone, 18 to 28, I'm happy. When my investments go, what is the benefit? When my investments go above the 28% zone, I'm able to take a cash call. Okay, that the Nifty in the period has done say 18. I wanted to be in the 27 to 36 zone. I am doing 45. Okay, there is something exuberant about the markets right now that I am much above my top band. Then maybe I take a cash call. And then the markets, they take a rest for some time. If they do, and 1 year passes, and that 44 automatically becomes 38. So this is how I operate at INVasset. Yeah, you have to think how much risk you are going to take, and a major factor is the risk. We never talk about risk in entire conversation. The biggest thing that I'm a fan of is risk. Is no, we don't take care of that. We're always concerned about. There's a lot of research that has gone into return, because it's easier. When you come to risk, it's boring. Yeah, it's something that we don't want to talk about. Yeah, so the break system of the world, the risk part is very, very important. How much drawdown your strategy gives you. For example, at INVasset, if you're focusing on the 18 to 28%, our drawdowns are also bigger. Where the top 200, which is a 16 to 18% zone, stops at a 15% drawdown, our drawdowns go up to 20%. So we are having a +5 in drawdowns as well. And that is why we are able to have a +5 or +7 or +8 in the return side as well.
The alpha
So
creation.
whenever you have to compare a fund manager or a strategy or your own strategy or a mutual fund or whatever, you have to look at both the factors. जब drawdown आया, simple, I am not a fan of these trainer ratios, this ratio, that ratio, does not mean anything for me. You should just be concerned, CAGR कितना आया, what is the CAGR I am getting, and at what cost of drawdowns. That whenever the bad time came, how much drawdown does this fund have generally? If you are able to do that, and if you are able to align your mind with it, I think it should be good for you. That is how I, as an investor, think till today. कि मेरा नीचे कितना जा सकता है और मेरा ओवरऑल कैगर ओवर द ईयर्स क्या बन रहा है. दैट इज इट फॉर मी. Don't be confused by, I believe they are very, very good ratios, but I will just pick up and throw them in the dustbin.
Okay.
Yeah, too much complicated. कुछ नहीं समझ आता मुझे तो. I've studied all these ratios in my when I used to study, but in real life I've never ever used them.
Okay, so talking about the funds, so you have growth fund as a PMS, which is your flagship fund. You have recently launched prime fund as a PMS and leaders fund as a PMS. So if I'm an investor, which one should I invest in? Because as an investor, I may not have the liberty of going into all the funds. So which one is your top favorite and why?
See, I am primarily into the growth fund for myself. I am investing in the same stocks as the growth fund. What is the difference? The difference is very, very simple. A lot of investors say that Anirudh, growth fund is a very good fund, but we don't like the small cap part of things. So make a fund for us which does the same way, value, growth, quality, safety framework, but without the small cap. So that is the leaders fund. Leaders fund has something that the distributors also like you, where you say that, Anirudh, we want a fixed fee model. Yeah. So we do not have a fixed fee model in the growth fund, but in leaders we do. The only two differences. In the third part, the what do you call it? The prime fund. The prime fund says that, okay, a lot of my investors and very, very good investors say that we don't want to invest in the old economy part of things. Like we don't want to invest in the PSUs, we don't want to do metals, we don't want to do real estate companies, we don't want all the cyclical part, they don't want. They just want those consistent earning companies. So in the same value, growth, quality, safety framework, instead now put all the small caps in, it becomes a normal growth, and take out the old economy part. Same. And that also has a fixed fee model. So these are products which will have more or less the same return, maybe a little bit less, little bit more than the growth fund. But growth fund is, I think, more just when we say that we will charge you only when we make profits for you, not on the fixed fee models. And it has all the experience and expertise that we have gained, that I have gained over the past 20 years. So for me, it is the INVasset Quant fund, the original growth fund.
The growth fund.
Yes.
And then it is a specific requirement. If somebody has, then he has to look into prime.
If you don't want to do small caps, then go for leaders. If you don't want to do old economy, then go for prime. Yeah.
Okay. Also, I want to congratulate you for the Gift City AIF that has been launched by INVasset recently.
Thank you.
I hope it's doing well, or it's
We're just starting it out now. Okay. I think it's a wonderful product for our NRIs. When I invest for NRIs in India in INVasset PMS, I feel so much pain for them. That was the prime reason we started the Gift City fund as well.
So
all the TDS, this, that, all these things, the banks making hefty profits on transaction charges and people losing out on it. I was very much, moved when I saw one of the statements of one of our clients, and I was like, yeah, this is not fair. So though it has, and I think it's a step in the right direction. The government is doing, see, the gift fund for NRIs. Let me tell it to my NRI friends out there.
That is
the biggest.
We want to understand exactly what Gift AIF is going to do as INVasset's gift.
Not as INVasset, for any. We are an investing fraternity. It's for everyone. See, there are three types of taxes in India: the long-term capital gains, the short-term capital gains, and the business income. The long-term capital gain you pay when you hold a particular script and you sell it after a year. Short-term is less than a year. When you hold it less than a year, depends upon the holding period. And when you are doing daily buying, selling in cash market segment, or you're doing the futures and options market segment, then you track the business income side of things, which is 33%. This is around 15%. The long term, short term is 20%, and the business income is around 30, or whatever the highest tax bracket that you are. Yeah. So the first two taxes remain the same through gift as well. But the third part, the business income side, changes altogether. Okay. The taxation in that is zero.
Okay.
So if the strategy is where you can maybe churn a bit, and then you show it as that we are active traders, okay, then the tax is zero. or if a stock that you're buying is listed in the futures and option segment as well. You pick up the stake that you want to buy, say 4% of a particular stake, say HDFC, AMC, or Reliance, or whatever you want to buy. You buy it from the futures segment, then there is no tax on it. So NRIs will end up saving a lot on taxes. Then I, as a fund manager, I'm charging management fees from you. I'm charging performance fees from you. That has a GST component. Yeah, the GST component is not there. Yeah, so you end up saving on the GST component also. Thirdly, the income that I am making as a fund manager or a fund management entity in the gift city, there is no income tax on it. So of course, I am getting more money post tax, since there is no income tax. Then the structures there will be more competitive in terms of fees as you are getting in India. Yeah. So Gift City, I believe, is a wonderful, wonderful product which has been set in for investors. And a lot of new things are coming, like the Gift Nifty hedge. Though it is not, there's a gray area on how much of it is allowed and how much of it is not allowed. We are working on it, but you'll get more opportunity and you get access to a lot of markets. When you're sitting outside India and you want to invest in India, and maybe the opportunity shifts for a few years to, say, some other markets like the US in a new economy, I always say that in a new economy, it is the US NASDAQ that will be the leader. Yeah, as I believe should be for the next 1 year as well. It should, according to me, it should be the leader in terms of indexes all around the world, major indices all around the world. So you are able to take benefits of these things as well. So you're getting the benefits of diversification, you're getting the benefits of taxation, and then all these disbenefits, all these things that you are doing right now, the TDS, the taxation, your money not coming for 10 days. HDFC, after selling of liquid fund, does not give money for 10 days. I was so pissed off with them. Yeah. And we have it on the record where we are asking the officials, why is my client money not coming after 10 days of selling my liquid fund? And they are saying that, oh, these are RBI this and RBI that and whatever, who knows. You are at the mercy of these big banks. All this goes away. So for my NRI brothers and sisters, it is 100%. You have to invest in India through Gift City rather than doing it with us how traditionally it is being done.
Wow, this has been wonderful, and we wish you all the best for Gift City AIF and also for your growth fund and the Prime and Leaders Fund, Anirudh. And thank you so much for taking out time and talking to us at Returns and Beyond. So, friends, this chapter of Returns and Beyond has been instrumental in letting us know so many things. Number one, 26 is the year of growth, and we should be expecting a lot of good alpha coming in. Also, for the investors, the young investors, there was a lot of insight as to how you should be taking mutual funds, PMSs, AIFs, and then go into direct equities. Also, we learned about AIF gift cities. So this has been a great run. Thank you so much for your experience, and we'll keep on having such a chat with you again and again, especially when you
and
go
I
on
wish
to the
you
next
and
cash call.
Wealth One as well. And the way you guys are branching out, very, very nicely. Keep it up.
Thank you. Thank you so much.